Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over a bunch of commodity and stock market related information. I'll give you my financial opinions on it. We're going to go through Twitter, and I'm going to give you my opinions on it. I go through Twitter when I kind of just want to give market update information. It's kind of an easy way to consolidate everything. And a lot of other people give opinions on it, and I kind of maybe counter their opinions sometimes. But yeah, we're in a big commodity bull market. And I think all the pressures are still there. And if you guys need help with anything, check out the finding-value.com. Use the word discount for a platinum membership if you guys are interested. And if you want to follow me, it's at finding_finance if you want to follow me on Twitter. So Joseph Brown says, highest month-over-month inflation in months, and December month-over-month deflation was revised to inflation. More fuel on the fire for the Fed to keep tightening. So this is the advance in U.S. consumer prices points to persistent inflation. And that's that last reading there. And I think a lot of people were somewhat surprised at the height of the inflation, how high it was, the level of it, and then how persistent and the level of it is. So it says, good thread on oil capital cycle. We're still early, with 2023 potentially the first year of mid-cycle capital spend, and many years of activity likely necessary to rebuild global oil supply capacity. It says we are at the onset of an upcycle with so much underinvestment the last 6 to 7 years. This leads us to believe that this will be like no other cycle that we've seen before. And this shortage in oil is going to lead to this consumer price index going higher. That is the driver or the translator of consumer price inflation. Is oil. Oil is the number one commodity. It is the most inflation sensitive as well. So if we have inflation problems, it's generally driven by oil. It's also driven by it's driven by two things. It's the shortages of oil that can drive inflation, and or how much money's in the system. The way that they measure it through the consumer price index means that you have to translate those dollars into the consumer price index, and that's generally through higher oil prices. So looking at this, it says, while most eyes were on the CPI today, there was a significant change in real wages confirming a recent upward trend. In fact, nominal wage growth is starting to move higher again, despite the deceleration in inflation. The economy still has a record of almost two job openings for each unemployed person. The rising labor cost pressure is likely to become another secular inflationary driver. Today's loose monetary conditions are only adding fuel to the fire. So this is nominal wage growth year over year. It is heading on up. So that is interesting as well. We've got Grady here. He has a lot of really good posts, though. Contemplating this post will most probably be one of the best spent moments of your investment life. I have a few times called for what I named an everything non-USD move or up move. It might be that we are in for one of those again soon. So this is gold, and gold, he put these gigantic waves in here. He's trying to put a Kondratiev wave. They call it K waves. He's saying the fifth Kondratiev wave, K wave, has lasted 54 years on average. Look at this. This is the MACD. This is the chalk and money flows. I used to look at all this stuff. This is coming on up, and we can see a big old move. You can see the breakout here for gold, breaking to the upside here. So gold could have a big old monster run to the upside. And what that means is that we're probably going to see inflation and a lower dollar. And it doesn't mean the DXY. DXY is a relative strength indicator. The absolute value of the dollar declining, and gold increasing in, or I should say maintaining its purchasing power. So we're probably going to see a big move in inflation, is what this is saying. It says here, I still anticipate the CPI will collapse soon given the pace of the M2 decline. I'm either early or wrong, time will tell. So he's talking about this, but he still thinks, based off of the M2 money supply declining, that we're going to get some sort of pullback. Now here's the thing, it's basically the M2 money supply versus your velocity of money, because you could have less money in the system transacting faster, which will result in inflation because you're counting the money more over as it switches hands. So that is a possibility. The other possibility is we do get a slowdown because of M2 money supply decline. We also have the supply side of commodities, which I think is also kind of screwed up. And again, this is a world market now. America used to be a larger share of, we'll say, the commodity draw. And what I mean by draw, they're consuming commodities. But as time progresses, they're drawing from commodities less in relationship to the overall commodity draw of those commodities, or commodity demand, as we'll call it. China's picking up, and China is actually loosening, more stimulus, reopening, and same with India. So over there, they're on a different cycle than we are. So I don't know how this is all going to kind of work out in the end, because if they're drawing commodities to their areas, and we are still in a demand for commodities, I mean, commodity prices could go up, increasing inflation through that consumer price index. And this is what I'm talking about. The COMEX silver inventory down another greater than 1 million ounces today. Hedge funds crowding into future short positions while the market has rarely been tighter, setting up for the squeeze of the year with Peru imploding, China exploding, and Russian escalation as massive catalysts. So we do have all this going on in the background. We've got a lot of big macro picture stuff going on all at once. And the markets are getting a little bit harder to navigate. And that's why I do look at technical analysis, and we still have monster patterns, basing patterns in all these different commodities. And that's why I like looking at this. So this, Joseph says we'll see the CPI collapse. It's not necessarily what these charts are suggesting on a mid to long-term viewpoint. Maybe on the short term that's possible, but I think it would be temporary. It says gold broke out against the SPX, silver broke out against the SPX. Silver broke out versus the NASDAQ. This chart shows that also platinum has broken out against the S&P 500. An historical asset rotation is in the making towards precious metals. It's now back testing. So this is platinum versus the S&P 500 on a monthly candlestick. You can see a big, gigantic falling wedge. We've broken out, and then we're doing a retest, one final retest before I think we go to the motherland. I'm loaded to the gills with this stuff, guys. I put my money where my mouth is, and I am waiting patiently for this to all happen. I bought the crap out of this bottom, guys. I bought the bottom of 2020, slightly after 2020, that crash. I bought in 2022. I've been buying the whole bottom of this thing, with platinum in particular, physical. So I've been doing that. I've been putting my money where my mouth is, and I share what I'm doing on the website. So first order thinking, higher rates means lower inflation. Second order thinking, higher rates means less investment, less CapEx to expand supply for commodities already in a deficit, and thus even higher inflation later. Level up your thinking. What I do is I go straight to the drivers. Credit expansion is the driver of inflation. And then another thing is that supply problems or deficits. And I don't know what order of thinking that is. Everything else is a tertiary effect of those things. It's the demographic, the real estate market, which is credit expansion, those two interacting with each other, and then the deficits of commodities. If you have large deficits, that translates the credit expansion into the consumer price index, increasing interest rates. Higher rates does not lower inflation necessarily, especially if you measure inflation through the consumer price index, because if you go short in commodities, that will push consumer prices higher. Inflation from the money supply or credit growth, that comes from the housing market. So higher rates can slow down inflation and lower inflation from the credit side, but it might not help the supply side, which is also inflationary if you're measuring prices through the consumer price index. Now, here's something that's kind of interesting. I saw South Africa, by a large percentage, is the world's central supplier of platinum. It's 70 to 80% is what it supplies. But look at this. It says I don't know how to say this guy's name, to appoint Minister of Electricity as crisis is declared. So he announced he'd be appointing a new Ministry of Electricity in the presidency, coordinate the response. They have basically an electricity crisis going on over there. Maybe that impacts the platinum production. I don't know. But platinum's looking good because you're throwing this on this, right? We're having problems with energy. And then we're basically setting up a gigantic move in platinum versus, I think, almost every single other asset. Platinum versus the S&P 500, platinum versus NASDAQ, platinum versus gold, platinum versus palladium, platinum versus silver, platinum versus rhodium. Platinum's cheap against everything, guys. And it's putting in these monster falling wedge patterns that just, it's ridiculous. Just ridiculous. Sorry, I have to say it's ridiculous. WTI oil gap down in the morning. It also fought back throughout the day. So that's something. And that was on higher inflation numbers, kind of a sell the news type thing. Here's another thing that's kind of cool. This is a 2-year consumer price index heat map. It says also too early Fed forecast of 6.1 headline and 5.4 core. So this is 2 years of a heat map. And you can see that we were very inflationary in terms of the movements in motor fuels. Gasoline was really hot through here, and it has slowed down recently. We also saw fuel oil, electricity, basically anything energy related was really hot, and it was in the red areas. We also had some red areas, if I can read this, in household type stuff, and airline fares went up in the red here. Airline fares, this is household stuff in the middle here. We had some red on used cars, went up massively the past, I would say, year. This is March CPI all the way till April. So we had some pretty good inflation, and it has slowed down a little bit recently. Definitely has. This is the Baltic Dry Index. We are at levels of what I would see as the break-even cost. On a log scale, you could argue that this is one big inverse head and shoulders in the Baltic Dry Index. And you can see shoulder, head, and then another shoulder that's developing here. We're also seeing inverted head and shoulders on a whole bunch of different commodity patterns. If this is an inverted head and shoulders and we do break out to the upside, this could be a big old run because this is a monster run from 99 all the way till 2008 in the Baltic Dry Index. Coming down, this is Nat Gas. It says a serious try to find a bottom and to rally to $4 here. So we are moving across here. And the reason I'm saying that is if you look at the lows are basically moving sideways. So I do think natural gas is bottoming here. I would be looking at it myself for potential entry points right here, right now, and be kind of cost averaging in because I think it's firming up quite nice. But that's me. I'm always early. I'm almost always early, guys. So I kind of sprinkle my money in. I'm not a buy everything all at once, but yeah, it's looking better. It's looking better. That's what I'll say. Now here's something that's insane. It says the shelter component of the consumer price index just had its highest 2-month increase in 33 years. This is the U.S. consumer price index for just shelter here, and you can see this thing really rocketing here to the upside. I'm sure that's a function of interest rates and the affordability and all that stuff for that. But you got to keep in mind, though, this will come down at some point. If you're at the largest increase in 33 years, you're going to revert to the mean at some point. And affordability will get better. It could be declining interest rates. It could be rent subsiding. And remember, this is a year-over-year kind of move. Or this is 2-month change, 2-month change, percent change. So I do think it will slow down at some point. Doesn't mean it'll go negative. Just slow down. It says premium oil production down 10% in the last 2 quarters and down 6% year over year, while gas to oil ratios are rising rapidly. It equals acreage is maturing and degrading. Still 30% more expensive on an enterprise value on a barrel of oil equivalent versus MEG energy. So that is also some more information on that. We've got hopefully the Billionaires Club knows something that we do not know. So this is billionaire John Paulson. I follow him too every once in a while. It says the US dollar's devaluation will drive gold up considerably this year. He says gold is likely to continue to appreciate in value over the next 3 to 5 years. I agree. I'm a big precious metals bull. In fact, I like platinum even more than gold. Platinum just it's insane. You've got if you play it through the precious metals, you've got super low risk because metals are the lowest risk investment in terms of default risk. Doesn't mean you don't get volatility. You still get volatility. You still move around, but it's one of the lowest risk areas for default risk. Bonds can default, and bonds do not do well under a inflationary environment, which basically is the inverse of the US dollar going down. So inflation goes up, dollar goes down, and gold, I think, will do very well along with a lot of other precious metals. He's talking about real house payments are now $2,900 a month. Historically, real home payments above $2,000, slow construction spending, and then payrolls. So restoring housing affordability without crashing prices is key to pulling off a soft landing. I agree with that. Totally true. Says this is possible, but not improbable. A quick thread, and I don't know if this is inflation. Oh, it is inflation adjusted monthly payment. So there it is. And we've come up a little bit, and I do think this does have to come back down. Maybe interest rates come back down. I don't know. But interest rates being high also causes problems with deficit spending in the government. So that's kind of where we're at. This was a reply. This is wealth by generation. And the millennials are rapidly increasing their wealth. So I know some people say, oh, they're broke millennials. But overall, guys, millennials are killing it. I'll just say that. They're saving lots of money. This is when people say America is Japan now. It says the M's and the Z's together are more significant than the total population of Japan today. So if you look at the millennials here and the Gen Z, if you add these two for population, it's greater than Japan. But I also want to show you that as you look this way, the demographic rolls upward as you go and hit about 30 years old of the millennials. The average home buying, the average first-time home buyer is around 35 to 40 years old. We are still climbing up the first-time home buyer demographic and at ever larger volumes. So they're coming into home buying years. That puts that pressure on the home prices and pressure on new housing starts to start more. So I think we still have another 5 years. That puts us out at 2028, maybe 2027, maybe 2029. We see some sort of peak. It really depends on the demographic and how fast we can build these homes. The demographic being like when they're going to actually buy a house. Is it going to be now? Is it going to be 2 years, 3 years, or whatnot? And what that first-time home buyer is. But that's what I've got for today, guys. I'll end it there. I went over a lot of information there. And I still think everything looks absolutely fantastic for a commodity bull market to occur. I don't see any major problems. Could we get a slowdown? It's always possible to get a slowdown. It's always possible to get a pullback. Yeah, I agree with all that. But I'm in the camp where I don't think a small pullback is going to hurt. I don't think it's going to be like a gigantic crash like 2008. I mean, yeah, the NASDAQ is probably going to pull back with increasing interest rates or if rates stay pretty high. But yeah, I think everything's in line and everything looks good. So give me a thumb up for the content, subscribe to the channel, and we'll catch you next time, guys. This is Finding Value.